All right, so in this video, I'm going to talk a little bit about common stock. So common stock fundamentally has some form of ownership associated with it. So you are an owner of the company if you have common stock. Now, it could be ownership in a privately held firm, in which case, if you own a company that is incorporated, and you own all the shares, so you technically you have stock and you have the ownership, but that doesn't mean that it's traded by other people. It's just a privately held firm. On the other hand, a public firm would be like an Apple or a Microsoft or an Alphabet, something like that, where the stock is traded publicly. And so there's still shares of stock, and you can accumulate ownership by buying the shares of stock, but it is traded on organized exchanges and publicly. Now, for the most part, one of the main things you get to vote on as an owner of common stock is you get to vote on the board of directors. And who is the board of directors? And if you have enough votes, then you can have a significant say in who's on the board of directors, and the board of directors then has a big role in selecting the chief executive officer and the management team of the company, which ultimately then directs what direction the company goes. So that's one of the main things you vote on as a shareholder is who winds up on the board of directors. Occasionally, there'll be other things that are put to a shareholder vote as well. So you might get to vote on some other things as well. Now, common stock technically does have a par value, and so the par value is going to be the amount that's listed on the balance sheet for all the shares that are sent out there, or issued, I should say. Having said that, though, the par value really has very little connection with the actual value of the stock, because the value of the stock is going to be related to the present value of all expected future cash flows, right? And so if that's what's driving the value, the par value is just sort of for record keeping purposes, really. It doesn't really have much of a connection to the actual value as it relates to the shareholder. Now, common stock may have preemptive rights. So preemptive rights basically give the common shareholder some rights that relate to kind of some things that would occur that would create dilution of ownership or dilution of earnings. So let me give you an example of that. So let's suppose I own 30% of a company, and the company then issued a whole bunch more shares. Well, if they issue a whole bunch more shares, then all of a sudden I don't own 30% of the company anymore. I own a lot less because I have my shares, but now the pool of shares is larger, so I would now own less than 30%. So I would have then my ownership would have been diluted, and the earnings that would be attributable to my shares would be diluted, and this would obviously not be great for me as a shareholder. The idea behind the preemptive right would be that if the company is going to issue a whole bunch more shares, I essentially get first shot at buying enough shares of the new shares that are going to be issued to maintain my 30% stake in this example. So it basically helps to protect the shareholders from dilution of ownership and dilution of earnings and things like that, because I will still wind up owning, in this example, if I buy out the shares, I'll still wind up owning the 30% of the company. Now, that brings us to authorized, outstanding, and issued shares. So authorized, these are the number of shares that the company has been authorized by the regulating body to issue. So think, Securities and Exchange Commission, that kind of thing. The issued shares are the number of shares that the company has actually sold at some point. And then outstanding is going to be the issued shares less whatever the company bought back for treasury stock. So if the company actually issued, say, 1 million shares, but then they bought back 200,000 of them, then outstanding is 800,000. It's however many they're still out there essentially in the hands of shareholders. So that's the difference between authorized, outstanding, and issued shares. Proxy voting is when you, as a shareholder, can assign your vote for your shares to somebody else to vote. So you can essentially allow somebody else to vote in your stead or by proxy. And so that brings up the topic of a proxy fight. So a proxy fight or proxy battle would be one in which, let's say, I own 30% of the company, and I want to implement some different changes in the management. So I've got some say in what's going on the board, but I don't have a controlling interest in the company. So I come to you as the shareholder as well, and I say, hey, transfer your votes for your shares to me. So essentially, this is allow me to vote on your behalf. So that's where the proxy voting is coming from. But if you allow me to vote on your behalf, and I get enough of you that are also shareholders in this company that agree, together I can accumulate together perhaps over 50% of the votes. And then I have over 50% of the votes, and that means I can actually implement who we want to put on the board of directors, and then maybe implement my plan. So that would be the idea behind a proxy fight, where I try to get enough people to essentially assign their votes, so I can vote on their behalf. and we can get enough votes so we can implement my plan. Generally, this is going to happen if I, as a shareholder, have a plan that the management of the company doesn't exactly want to go along with. And so I'm trying to get enough votes to basically force the board of directors to go along with this. Or perhaps another way of putting it would be to get enough votes to basically put on the people on the board of directors that are going to go along with my plan. So I might just flat out change who's on the board of directors, get people who are amenable to my plan, basically. Some companies do have multiple share classes. So they could have, a class A share and a class B share. And, the class B share could be significantly have more votes than a class, or a class A share could have more votes than a class B share or something like that. So you can have some situations like that where different share classes have different amounts of votes. So you kind of want to pay attention to that if you're buying stock in a company. There are some companies that have essentially super voting shares, and so somebody might not have a lot of shares, but they have especially designated shares that have extra votes. So those would not be the kind of shares that would be publicly traded on the New York Stock Exchange or something like that typically. But it could be perhaps owned by the founder of a company. So if you had a founder of a company and shareholders agreed to allow the founder to have kind of a outsized influence on the company, then the founder might actually have super voting shares where his shares are basically get a whole bunch of extra votes. So he might have one share, but that share might be worth 30 shares worth of votes to somebody else. And the idea behind that would be perhaps you want the founder or some key individual to have a significant amount of control over the firm. Maybe they were the founder, they're the visionary, they came up with the idea, they're the driving force behind the company. And so shareholders basically say, here's a way that individual can retain essentially functional control of the company because we think their vision is going to be best. We want them to walk out their vision, but also the company can still sell shares of stock to raise capital to walk out the vision. So that would be one way that they could do that. Now, the downside to that is that basically means if you are not one of the people with the super voting shares, you could still perhaps vote with your shares, but you don't have a lot of say. So that's kind of worth noting. And there are some scenarios where you can have some non-voting common shares. So there are some scenarios where that can exist. So you'd want to pay attention to that if you're buying shares of stock, and just make sure are there super voting shares associated with this company? Are there multiple share classes? What are the relationships between the different types of shares? A lot of companies only have one kind of stock, but there are some that have multiple. And if you own a share of common stock, if the company pays dividends, which they may not, but if they pay dividends, then you basically can get a dividend. And that will become a little bit more relevant as we move on to talking about stock valuation, and as I address that in subsequent videos. That brings up ADS and ADR. So an ADS is an American Depository Share. So basically, if you have international companies, it can be tricky for investors in the U.S. to invest directly in an international company. So the idea behind American Depository Shares, or ADS, is basically they take shares, they're kind of receipts for shares that are purchased in another country. And those receipts are basically used to back up an ADR, which is an American Depository Receipt. And so the ADR is what people can then buy on a U.S. stock exchange. So here's basically what that means. I could then, as a prospective shareholder, go out on a U.S. stock exchange and purchase an ADR. And it looks like a share to me. It feels kind of like a share. But what I'm really buying in the ADR is essentially I'm buying a slice of ownership in this pool of foreign stocks. They're basically kind of held on deposit, if you will, or reserve at a financial institution. And so what I'm kind of buying is a slice of ownership in this pool of stocks that are related to some international company. So let's say that it's a company from the Eurozone. And so basically they buy a bunch of stock in the Eurozone denominated in euros. They take that stock and then they basically hold that on deposit. And then once they hold that on deposit, they sell American Depository Receipts that are essentially you have kind of a stake in that pool of shares. And this basically makes it possible for you on a US-based exchange to buy an equity stake in a company that is based somewhere else that is denominated in some other currency that normally trades on some other international stock exchange, for instance. Okay. All right. Hopefully that kind of makes some sense. Thank you so much for watching and have a great day.